Nvidia has just reported their earnings. We can see they are already up over 3.5%. Today we are going to cover everything that has been released from this phenomenal report, including a 10-for-1 stock split, as well as a dividend increase of 150%. We're going to take a look at the exact numbers. We're going to look through and see where the growth is, not just on their revenue, but also on their margins. And we're also going to take a look at how quarter on quarter they seem to be increasing every single income stream. It is definitely something that you do want to listen to in today's episode. When you thought things couldn't get any better with this company, a 262% jump in their sales, and there is a lot to love, not just for this company, but this will now impact the wider market as well. Today's episode, we are going to take a look as well at the historical performance of Nvidia, how they've been performing. We want to show you historically their top line revenue growth, which has been insane, their bottom line net income, as well as their very strong bulletproof balance sheet, their total cash versus their total debt. We'll very briefly touch upon their dividend safety. Now they have done an increasingly very strong dividend of 150% into next year. We'll also look at their growth on a free cash flow basis as well as other metrics. Again, this is a company that is very strong and doesn't look to be slowing down. And we'll look at both insiders who have been selling even after the increases to the share price, as well as institutions to see what they have been doing with this company quarter on quarter. And as always, what we are going to do in today's episode is revisit the valuation model. We're going to get to our own intrinsic value of Nvidia after the news today, our own acceptable buy price given our investor margin of safety, as well as running through the whole DCF model so you understand our essential valuations going forwards on a low, medium and high rate. So let's start off with their earnings to see how strong it was, and we just want to say you are reading that correctly, a 262% jump in their sales, and as we can see, they do believe the AI boom trend is going to continue for much longer than what people had anticipated. Now at a very high level, we just want to point out they beat the earnings per share 612 adjusted versus the analyst targets of around 559, and we can also see on their revenue 26 billion with the market anticipating 24.65. So this was a very strong beat for Nvidia, both on earnings as well as their revenue. When we take a look at their press release, now a few things that we do want to point out that we have already mentioned. A 10-for-1 stock split effective June this year, so literally just a few weeks time. What this means, if you essentially have one share of Nvidia right now, June the 7th you will have 10. Essentially the share price will be divided by 10. So for example, if the share price gets to $1,000, then right now it would essentially come down to $100, making it a lot more affordable for people who can't do fractional shares investing. Another thing that we do want to point out, they have increased that dividend 150% to 1 cent per share on a post-split basis. Now their dividend was never anything massive, so nothing that we really want to point out or run through, but just nice to note for those who have been holding this company for a long time, that is a fairly strong increase to their dividend. Now in terms of the numbers, and you know on this channel what we always love to see, not just increasing revenue, but oh boy do we love it when we see increasing margins. Now just the previous quarter they brought in 22 billion worth of revenue for Q4 FY24 with a gross margin of 76%. Now in this quarter they're looking at 26 billion, very large increase when this was already a massive increase from the quarter previous, and 78% on a gross margin basis. So this is a company that is increasing rapidly both on the revenue and on the margin, one of the things that we really do love to see on this channel. On top of that, when we break it down, looking at the different income streams, well, data center is going to be the one that they have grown very rapidly and have continued to quarter on quarter. This is not a joke. We are talking about some very rapid increases. Just look at Q1 from FY24, so just a year ago, 4.3 billion was how much they brought in data centers, 22.563 billion, and even from the previous quarter that was 18.4, we are still talking about a very rapid growth. Now the other sectors, there have been some increases, some decreases, gaming slightly down, professional visualization slightly down, auto is up, and we do see OME and others slightly down, but overall the one that will get most of the plaudits and the talk is the data center, which does not seem to be slowing down at all. And we can quickly revisit their presentation And in fact, what they did mention as well, that the CEO has said the next industrial revolution has begun. Companies and countries are partnering with Nvidia to shift the $1 trillion, as we can see, traditional data centers to accelerated computing and building a new type of data center. Now, something we have talked about before in other episodes, this is an industry that is growing 30 to 40% year on year. So this isn't something that we do expect to slow down in the near future. So with all the talk of this company, some phenomenal earnings as well. We have that 10-for-1 forward stock split as well as that dividend increase by 150%. We can see that the record quarterly data center will take all of the news, 22.6 billion, up 23% from Q4 and 427% from a year ago. So a lot of information to take in today. This is going to be a very detailed episode, and we can see right now it is trading around 3.41% up after the post market. A lot of traders as well as investors loving the fact that this will now be a lot more affordable to them. And we can see over the last year up 205%. Again, very rapid growth. In fact, just year to date, nearly doubled, up 93%. And if you have been a long-term shareholder, then I wouldn't be surprised if you have a picture of the CEO tattooed on you, up 19,696%. Now, this is also one that Wall Street has maintained for quite some time at a strong buy level, a buy from Seeking Alpha, and I don't know what quant are thinking, but they have this as a hold for quite some time. We also note that it is trading right there at the 52-week high. The forward yield will be slightly higher now after the news of the dividend increase, and we also see that the forward P 37.55, it is very high compared to others in the sector, but some people will argue that this is very, very justified for this company. Now, in terms of insider ownership, we have seen a lot of sales, 4.23% in fact, total insider ownership, 9 instances of sales over the last 12 months, and what we do see, 340 million in total over this period. More recent one, 20 million in Q2 and around 75 million in Q1. So when we take a look then at who these individuals were, well, the more recent one, 5th of May, we do have Mark Stevens. He also sold on the 28th of March, sold many shares, in fact, 22,700 at just under $880 for a total of just under 20 million. Now, as we always say, this isn't what we would say a bearish signal, as we don't know why they sell. It could be personal reasons, could be financial, but the information is there if you do want to include it. And also note the share price is now higher than what he sold it for last month. In terms of institutions, so a very similar analysis, 65.3% as we can see here, 85 billion worth of sales by the institutions. Over the same period, a significant amount more buying, 668 billion. But one thing that we do want to point out, in the more recent quarter, Q1 of 24, that institutions did sell more, or in fact double than what they bought during the same quarter. Just something to flag. Overall though, over the last 12 months, they have been buying more. Now, before we continue, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, for example, where we run through 20 undervalued dividend stocks, all completely free, click on that pinned comment below. You will gain instant access to all of these. How to find undervalued stocks as well. In this, we do run through all the websites and resources we use. As we said, free, instant access by clicking on the pinned comment below and taking a look. So in terms of their growth, very quickly then, we just want to point out that their top line has been increasing very rapidly. Whilst we want to see 3 to 7%, 4.7 billion in 2015, 61 billion as we can see here in January 24. So very, very large growth. And with data centers going up, as we said, just on an income stream alone, over 400%, it doesn't look like this is slowing down anytime soon, especially with those partnerships that the CEO had mentioned earlier. In terms of the bottom line, well, huge growth, 631 million 10 years ago, and we're talking about January 24 for the full year, 30 billion. That is an insane amount, and as we can see on a graphical basis, it is looking very strong. Now, obviously, the question will arise whether or not they can continue this increasing trend, but it does look like over the last 4 quarters and the last few, they're just continuing, as we can see here. The increase from Q1 FY25 to the same quarter a year ago is very, very large. In fact, more than 3 times, as we said, around 427%. In terms of the balance sheet then, a quick health check. Well, 4.6 billion on that balance sheet in 2015, 26 billion in their latest quarterly report. So they hold a lot of cash, and it is something they have been growing over the longer term. When we compare this then to their total debt numerically and directionally, 1.4 billion as we can see here to 11 billion. So in fact their debt, yes, it has been increasing over the longer term, but their cash is far more superior, and if they wanted to, they could pay all of that debt net of cash on hand in pretty much one day. So then we take a look at their earnings. Now this is something that we typically do before they report, so this is slightly outdated, but the last 4 quarters they did beat every single one. They have a 100% track record, and as we now note, they did also beat on Q1 2025. And as we can see, they had over 412% year-on-year growth to their earnings per share. The good news for shareholders, this isn't expected to stop anytime soon. The next 3 quarters as well, very large increases. And if they do maintain that earnings per share expected in 2026, then the forward PE will be just under 30. Again, it is up to you whether or not you do believe that is justified, or in fact it should be a lot lower. Speaking of that, well, we do have a quick look at the valuation grade that has been given for Nvidia. It is an F score. Now, one of the things that we do look at is the P gap on a a P non-gap forward basis. 37.55, we can see the sector median 24.17, so it is in fact trading a lot higher at a premium of 55%. Now there are other valuation methods if you do want to take a look. We can see every single one. They are very, very expensive in comparison to the sector. But again, it does come down to that question, is it justified that Nvidia trades at a higher margin and higher percentage than these other companies? Again, that is something that individual investors will need to do their own due diligence to come up with the answer. I mean, A+ across the board on growth, absolutely no surprises there. Year-on-year growth over 100%. I mean, the sector coming in around 3%. It just goes to show you how strong this company is. Forward basis, 74%, a lot better than the sector median. And again, the same can be said for every single one. I mean, they're anticipated to grow their EPS over the next 5 years, 35% year-on-year, with the sector median around 13.79. So it just goes to show you how strong this company is. The metrics do explain the story pretty much themselves. Now, profitability grade, A+, very strong gross profit margin, 73%, which only gets stronger year-on-year, quarter-on-quarter. We can see the sector a lot lower, in fact, 48.2% lower. Bottom line margin, nearly 50%, and we do see the sector median at 2.64. And one thing we do like to point out, look at that cash from operations, 28 billion, with others looking around 93 million. So a quick little update then on this part of the analysis. A buy rating from Seeking Alpha, a strong buy from Wall Street, a hold from Quant, F on valuation, however, an A+ on both growth and profitability. So let's take a look at this part of the analysis where we do compare them to others in the sector in the semiconductors. We have TSM, a very strong one, Taiwan Semiconductor, Broadcom, again, very strong, AMD, Advanced Micro Devices. And when we take a look over the last year, Nvidia up 205%, completely outperforming others. Over the last 5 years, I mean, you can see the massive gap here between the others. We're talking huge. I mean, Avgo second, 491, or in fact third, AMD 505, so a massive gap. Over the last 10 years, absolutely no competitors, 21,000. Now, we're just showing this as one part of our analysis, but in reality, past performance is not an indicator of future performance, just something to note that we did find quite interesting to show. Now let's take a look at their dividend safety as well as running through their metrics. 89 score, very safe, absolutely no worries there. Market cap 2.35 trillion, a mega cap company, and their yield will go up slightly higher. This will probably be sitting around 1% once essentially that dividend increase and that stock split has taken place. Again, dividend cut does look to be highly unlikely, something that we also believe in given all the information. If you just want to know how they performed in the last recession, 07-09, the Great Recession crash, negative 35% sales, which was below the average, S&P around negative 12. They also trailed the S&P, negative 78%, with the S&P coming in at negative 55. Dividend growth, well, as we can see, 0% since 2018, so loyal shareholders are now rewarded on the dividend alone, up 150%. Now, we can also see they have been paying a dividend for the last 11 years without a reduction. Typically on the channel, we would look at dividend yield theory. However, it is irrelevant to this company as it is so low, so we won't look at it. What we will say, though, the forward P currently of 37.5 is below the 5-year average of 41.3. And we know it is significantly higher than the information technology sector of 26.3. Now, in terms of the free cash flow payout, whilst it isn't something we do want to focus on because the dividend is very trivial, still below 50% for semiconductors. I mean, 2024, 2025 expected 1%. We can see the dividend takes up a very minute percentage of their total free cash flow. Free cash flow, it is going to increase even further into 2025. We can already see the more recent year, 10.9, next year an expected increase of over 100% to 22.1, and this does look like it could be the potential beginning of the rapid increases to their free cash flow. Just something to bear in mind though, whether or not you believe they will be able to sustain this increase moving forwards. Like we said at the beginning, 3 to 7% growth year on year is something that we do tend to look at. However, what we can see for this tech company with our realistic expectations, double digits at a bare minimum pretty much every single year. We do note 2023 it was flat as well as negative in 2020, but 126% in 2024, expected to be triple digits again over the next year. This is a company that is increasing rapidly, and as we discussed, we'll shortly come on to the margins as well. We just want to mention with the shares outstanding, whilst we love it when companies do share buybacks, and they did say in the last quarter they're going to continue doing that, we can in fact see over the longer period they would have diluted you as a shareholder, but realistically you wouldn't really care at all given the share price return has been phenomenal over that period. Total sales, we have already seen this, just a different format. ROIC then, a very important metric, return on invested capital, 10% or more, or if you want to be industry specific for semiconductors, double digits, 12%. Reason for this is just to give us faith that management are able to effectively allocate their capital. Above 12% consistently, 61 in 2024, incredibly attractive for potential investors to consider to buy. Operating margin was significantly and consistently above the 16%, 54 in 2024, and as we just ran through, and if you've seen our other episodes, they're continuing to increase their margins, operational efficiency at a first-class rate. Free cash flow margin as well, well above 5%, 45 in the more recent year. This is looking absolutely phenomenal. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. As we always say, this correlates to both dividend safety as well as balance sheet strength. And what we can see here, in fact, zero across the board. These are a number of years it would take the company to pay off all of that debt, net of cash on hand. It won't even take them one day. As we said, their balance sheet is absolutely phenomenal. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we have the free cash flow year on year for Nvidia. Growth absolutely phenomenal. Just the last year, 610%. Average 94%. Now we've gone for 3 different rates so you can also see where the numbers are coming from. On a low growth rate of 22% with the discount rate at 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt to get to the equity value, divide by shares outstanding, and we can see an overvaluation signal. Now, a lot of people will say that is way too low, lower than the more recent year, lower than the average. So we've gone for a medium rate of around 24%. And we can see with the 24%, it would be showing implied downside of 3%. With the 22, implied downside of 15. For those things should be even higher at 26, where we would see an intrinsic value of over $1,000. And we can see that would be implied upside of 10%. Now, these numbers are very subjective. As always, by clicking on the pinned comment below, you can grab a copy of this valuation model, run your own numbers through. So, for example, if you do believe 30% is more attractive and in line with your thesis, then you can see here it would give an intrinsic value of 1,400. However, in today's episode, we will take through essentially the 24%, although some people could argue you could go slightly higher. With a 24%, what we would do, we take it to the intrinsic value. Now, today's episode, we only believe for Nvidia this model to be relevant. So at $939 and a current price of $972, we would say that it's currently trading at a premium above its intrinsic value. But for example, if you are someone that believes that you want to buy this at a 10% margin of safety, which we typically execute on this channel, companies at a 10% MOS level, if it does meet our 3 criteria, a wide moat, strong financial metrics and good forward-looking data, then you would have to wait to around $846. Now, even if you wanted a 5% margin of safety, it would be above to $892, and even if you just wanted to buy it at its intrinsic value, you would have to wait around $939. As always though, do let us know your thoughts in the comments below. In terms of Wall Street, well, they still believe there to be some significant upside of 23%. $1,200 is essentially their target over the next 12 months. But as always, let us know your thoughts in the comments below. There was a lot to run through in today's episode. Their data center revenue as well as their total revenue just continues to march ever higher alongside those increasing margins. And we can see as well a 150% dividend increase, a 10-for-1 stock split as well that a lot of people will love. But let us know your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.